Good afternoon, everyone. Thank you so much for joining us today. I'm Steve Seepersod. I'm part of the communications and marketing team here at Binghamton University. Pleased to welcome you on behalf of the Alumni Association to today's program, which is called Fortifying Your Financial Future. This is a webinar part of the Binghamton Learning Network. Because retirement planning is such a heavy topic, we've split this up into three programs that we're delivering this week. Yesterday, we had a session for recent grads. Today is for people in the middle of their careers as they get ready to think about retiring at some point in the not terribly distant future and find that they're saving for retirement while also taking care of kids and maybe also taking care of an older generation at the same time. You're in the sandwich generation in that age set. So we know you'll have some questions as we go. Normally we have a comment box on the microsite if you're watching where you can ask the questions that you would like to ask. Somehow that is not working, so feel free to email me your questions during the program and we'll get these mixed in where and when possible. We'll ask questions during the event and then also save them toward the end, and we'll take this program right up until 1 o'clock Eastern here this afternoon. If you are watching us on Facebook, welcome. Glad to have you there as well. You can add your questions into the comments on Facebook and we can take them there just as we would if you email them. So one method or the other, get the questions in. We like to make this interactive and fun as much as possible instead of a monologue from the presenter, and I know he'll enjoy taking your questions. So before we get to Paul, I'd like to introduce Owen Pell, a member of the class of 1980. He's the chair of the Binghamton University Foundation Board and is sharing some remarks on behalf of the foundation, which gives such generous support to many areas of our campus.
Good afternoon. I'm Owen Pell, the chair of the Binghamton University Foundation. The foundation is Binghamton's fundraising arm. We help the university's development office raise money, watch over the university's endowment and investments, and work closely with President Stenger to support the mission of the university. Even though we are a modest endowment of about $165 million, every year we give millions of dollars to the university, including for things where state money has been cut or is not available. Every year, for example, we give the university several $million for additional scholarships so that Binghamton can compete with other elite private and public universities for the best students. The foundation also has given millions of dollars to support the university acquiring land in Johnson City for the new nursing school complex and the new School of Pharmacy. In addition to alumni, almost 1/3 of our foundation board is from the Binghamton community, people who love the university and what it brings to the Southern Tier. The foundation provides all of us with a way of engaging with the university and making a difference. For me, that has been about two big projects. About 15 years ago, I endowed an honors thesis program and a thesis prize for undergraduates in philosophy, politics, and law. More recently, with an anonymous donor I located, we established an institute for genocide and mass atrocity prevention, which makes Binghamton one of the few universities in the United States to offer a master's degree and a minor in this emerging and important interdisciplinary academic area. Like many Binghamton graduates, many current Binghamton students, and many members of the foundation board, I was the first person in my family to graduate college. I have always viewed Binghamton as the place that launched me in life and as a gift that keeps on giving. We are particularly excited this week to bring you webinars on retirement planning. Most exciting is that we are offering 3 webinars geared to alumni that are at the beginning, middle, or end of their career cycles. We hope these webinars are useful and that you not only enjoy them, but use them as a way to reconnect with Binghamton University. Thank you very much for attending, and I hope you will continue finding ways to support Binghamton University. Go Bearcats!
Owen, thank you very much for those remarks. And I just want to mention that today's webinar is part of the Alumni Association's overall effort toward offering lifelong learning programs. So check us out on our website, binghamton.edu/alumni. And we'd love to have you involved in things like our online book club. We've just added an online movie club. We have the Tier Talk speaker series and quite a storehouse of content on the website. We store our past webinars, on there as well, and the Tier Talks events. So some great content. We had a great event at Homecoming for Tier Talks with alumni who are social media influencers, a very lively session. So check that out when you have a chance. And we will roll on now to bringing in our featured speaker for today, joining us from Westchester County. He's a certified financial planner and has been involved with our Metro New York chapter and Westchester chapter. Pleased to have Paul Tramontozzi from the class of 2001. Paul, thank you so much for joining us. Glad to have you here today.
Thank you, Steve. I'm really happy to be here and to kind of get back involved in the Alumni Association. I think it's been a challenging 18 months, 2 years for a lot of us here, and it's great to kind of get back into the swing of things. So first, I just want to say good afternoon to my fellow Bearcats, or for those of us that are maybe in the middle of our careers, you may remember the Colonials. So I know I got there right at the transition. So yes, I did graduate in 2001 with an economics degree. My wife graduated the same year as I did, and I stayed in Endicott. As while I haven't been up there in years, I do try and support the school, however I can. So today, I want to share a little bit of my expertise with you. As Steve mentioned, I'm a certified financial planner. I work with clients and families in Westchester County and now virtually around the country, thanks to COVID. So I'm going to share my screen with you, and we're going to talk a little bit about how to fortify your financial future. So just a little bit of a background. When I graduated in 2001, I spent my first 15 years on Wall Street. So I was a trader on the floor of the American Stock Exchange, and then I left the floor when that started dying down and was an algorithmic equity trader. So I did that until about 2015, and now this is what I do. I'm helping individuals get ready for their own retirement and help them meet some of their other financial goals. So looks like you can see my screen up here, Fortifying Your Financial Future. And let me just make sure I'm set up here. Yeah, okay. All right, so here's what I want to talk about today, right? I want to talk about some strategies for building your own retirement savings, right? We're about, for most of us, we're about halfway there, right? 20 years in roughly, maybe 20 years to go, give or take. So it's time to start getting serious about our retirement savings. Maybe just a 401k and a passive approach has gotten you this far, but for a lot of us, we've built up some assets here, and these next couple of decades are going to be crucial to get us to where we need to go. We're also balancing different financial goals, right? It's not just about building our career anymore. A lot of us have families. A lot of us have parents that are getting older. How do we balance these things and making sure that we could accomplish everything that we need to? We're going to talk about how important it is to have an estate plan in place. Maybe it's something that you did when you started your family or when you were younger, but it's also important to keep that up to date. So we'll discuss that. And given that there's only a couple months left in the year, I want to talk about some of the things that you should have on your radar, not only to finish the year strong and identify some planning opportunities, but also make sure that you're set up for 2022 as well. So let's just start by talking about retirement, okay? And how our retirement is going to look differently, than our parents' retirement, right? I mean, if we go further back, right, to 1935, when the Social Security Act was passed, the average life expectancy was 61 years old, right? So a lot of people, didn't live much further than the benefit that they received. So we know that that's different now, right? We know that we're living longer lives, and if we work till 65 years old, it's reasonable to expect to have 20 years in retirement, right? So with that, we're going to need a savings to basically support our lifestyle and supplement the income that we're not going to have outside of Social Security, right? Rising costs is coming back into the news again. We're going to talk a little bit about that. We haven't had much inflation over the years, but with the economy reopening, we're starting to see that. Another thing about our retirement that I think is different than maybe our parents is we're just more active, right? I feel like we travel a little bit more. We go out to eat a bit more, and especially in the earlier part of retirement, that's probably not going to slow down. In fact, it may accelerate, right? So how are we going to fund that type of retirement that may be more active than our parents? And that the last thing I want to cover on retirement is Social Security, right? There's a lot of uncertainty around Social Security and whether that benefit is going to be there for us. And while I do think it's fixable, a lot of the changes that are in the pipeline may not affect those close to retirement. For people like us that have a little bit of time, I think that we could see some changes, and we have to maybe modify our expectations of what that's going to look like. So the first thing I want you to consider is, are you saving enough for retirement, right? So a survey done in 2020 says about 69% of workers feel confident that they are going to have enough money to live comfortably in retirement. But, in addition to just putting money away every year and putting away as much as we can, given our situation, have we ever really tried to imagine what our retirement is going to look like versus how much we're putting into our retirement accounts to see are we saving enough? Is there going to be some type of a shortfall? So the first thing I want you to consider is, well, when do you plan to retire, right? I work with all types of people that want to retire at 50, people that never want to retire. A lot of people, because we're living longer lives, go into something like a soft retirement where maybe the expectation is that at some point they're going to work part-time. Start up a business later on in their career. So what is your retirement going to look like, and what's your time frame for that, right? The other thing you want to consider is how much income are you going to need, right? So rule of thumb says that we're going to need between 60 to 80% of what we spend now in retirement. But what I see in reality is that everybody's situation is so different, right? Some people, their expenses actually go up in retirement because maybe they travel more or they spend more time doing what they want to do, and some others may downsize and move to a smaller place and maybe their kids are off and not dependent on them anymore, and it might really go down. So the other thing is to have a sense of what your income is now, or what your expenses are right now, and once you can start envisioning what your retirement looks like, we could start to quantify what your expenses are going to be and how much income you're going to need, right? So once we know how much time you have before you get to retirement and how much income you're going to need, the question is what are your income sources going to be in retirement to cover those expenses, right? So one thing we'll touch upon is Social Security. So what should our expectations be for our Social Security benefit? On top of that, do we have other sources of income? Do we have a job where we're going to receive a pension? Do we have some passive income in rental properties? Where are our sources of income, and how much are we going to be relying on our savings, right? Because what used to be a three-legged stool for retirement, where we had our Social Security check, our pension, and our savings, is starting to become a really wobbly stool, because more and more people are going to have to rely more and more on their savings to get them to where they need to be in retirement. So having a savings plan is more important than ever for retirement. So when we talk about Social Security benefit, right? Well, most of us have a lot more working years left before we're going to start really claiming that benefit, right? You could start claiming your benefit between 62 and 70 years old, right? If you're born after 1960, like I think most of us here, your full retirement age where you would see your full benefit is 67. If you were to claim it earlier than that, you would accept a reduced benefit. And if you were to claim it at 68 to 70 years old, they will actually give you an additional benefit, additional credits to delay your benefit. So just to give you an idea of what Social Security benefits look like right now, if you were to retire, in 2020, basically on with these three different average incomes, $50,000, somebody at their full retirement age might have a $1,547 benefit per month. If they were to wait until 70, they could see $2,029. And if they just ran to their benefit right away at 62, it would be $1,045. The best way for you to know what your Social Security benefit is to set up a login on the Social Security website. So my Social Security, it's called My Social Security. It's at ssa.gov. You can put in your information. It'll actually show you your earnings history and an estimate of what your benefit is going to look like. Remember, you have enough working years ahead of you where it's going to change, because the way that Social Security is calculated is they're going to take your top 35 working years and they're going to adjust it for inflation and come up with an average of that to come up with your benefit. So while you may still be a ways off, it's not too early to look at your benefit now, to have a reasonable expectation of how much income you're going to need to replace in retirement. So that's Social Security, right? Once we have a reasonable idea about Social Security, the next thing is going to be how we're saving, right, for retirement. Well, like I said, inflation is coming back into the picture, right? We have an economy that's reopening. We have a labor force that's slowly coming back. We have high oil prices, and we have a supply chain issue right now. So all of these things together are leading to higher inflation than we've seen in years. Okay, so to give you some examples of this is if you have $100,000 saved today, and we have an average inflation rate of 3% annually, right? So the cost of goods and the cost of our general living goes up 3% each year, right? That same $100,000 that you're going to need today, you're going to need $180,000 just to keep up with it over the next 20 years, right? So we know that we need to save. We know that we can't keep all of our money in cash because we're just not going to we're not going to get to where we need to go, because we're going to risk losing purchasing power on our money, right? So inflation is definitely a concern. It's more of a reason to save, but also more of a reason why we need to invest, right? Now,
I'm sorry, Paul, if I could just jump in with a question, because
Sure.
about 2 slides removed from the thing I'm thinking about, and maybe you get this question a lot. We looked at 3 options for Social Security. Take the payment to 62, 66, and 70.
Yep.
And maybe you get this question quite a bit, where somebody asks, like, well, which of these is better? And it seems like that would be a hard question to answer, and it's probably by function of how long somebody lives, because at a certain point, if you live to be 100, probably better taking the payment later than taking smaller payment early.
Yeah, it's a great question, and definitely your health definitely factors in, right? If somebody has health issues and their life expectancy is much shorter than the average, well, then you're better off just claiming your benefit as soon as you can, and just to maximize what you get. On the flip side, if you have some longevity in your family, you may want to wait until 70 if you could, right? Knowing that while you didn't get the benefit from 62 to 70, you're starting at a higher point, and at some point, your cumulative or lifetime benefit is going to outweigh taking early. And we have calculators to help figure that out. Figure out at what age you would break even from claiming it at different times. But health is certainly one of the factors. If you're married, that's also another factor that comes into play here, right? Because knowing that if I were to have a higher benefit than my wife, but I were to pass away first, she would assume the higher benefit. She would assume my benefit. Not she wouldn't get both, but she would move to my benefit, which is higher, right? So a lot of times when we're dealing with a married couple, we do want to maximize the higher benefit, knowing that no matter what happens or who goes first, the second person is still going to end up maintaining that higher benefit, right? So for married couples, it throws another wrinkle into that. But really, the main factor in claiming Social Security is when you need it. right? Not everybody has the luxury of being able to work until they're 66 or 70 years old. And if there's not an adequate amount of savings on the side, people start taking their Social Security because they need to, right? I will say that for most people that are working, it's always going to make sense to wait until at least your full retirement age. And the reason why you should wait until your full retirement age is because if you claim your Social Security benefit before that, which for most people on this call is 67 years old, your benefit is going to be subject to something called an earnings test. So for every dollar amount you earn, more than roughly $18,000, it's going up to about 19,000 now. For every $2 you earn, $1 will be actually withheld from your Social Security benefit until your full retirement age. So if you're working and you don't need the money, it doesn't make sense for many to claim before your full retirement age. But once you're at that point, factors like your health, your income needs, and whether you're married definitely factor into that. And there's calculators you could use on the Social Security website. But as far as coming up with claiming strategies, that's where it really helps working with a professional. I hope that helps. So going back to savings, once we develop a savings plan and what we're able to put away, how do we combat inflation, right? Well, investing and the power of compounding interest is going to help, right? So in our examples here, it shows you that let's say we assume a 5% growth rate on some type of an investment portfolio, right? If you were to start with $49,000 and just invest another $100 a month for the next 20 years, okay? I'm sorry, you start with $25,000, invest $100 a month for the next 20 years. So your total contribution over that time period will be $49,000. With interest compounding at 5% a year, that contribution would equate to $106,000 in savings. So essentially doubling your money and outpacing any at least modest inflation that we would see, right? So compounding has a snowballing effect, right? So if we start with $100,000, then the next year we could have 105,000. Then we have 5% off of that new 105,000, and then every year we're gaining interest on a greater amount of money. And in those later years, you'll see it really makes a difference in growing our savings. So we know we have to save. We know we have to invest. So what are some of the tools that are available to us to build our nest egg for retirement, right? So if you work for somebody else, in many cases, they're going to offer you an employer plan, right? So either a 401k or a 403b account. Not listed here. Some smaller employers offer simple IRAs. And if you are in those 401ks or 403bs, right now in this year, and I believe next year as well, the maximum contribution you could make out of your paycheck and your earnings is $19,500. Okay, so that's not including any match that maybe your employer might offer, any profit sharing. It's just your elective deferrals, the money coming out of your paycheck for your 401k or 403b. You can contribute $19,500. So if you haven't looked at that in a while and you could contribute more, contact your HR department and see how you can bump that up. If you are 50 years old or older, you can make catch-up contributions to your retirement plan, right? So in addition to the $19,500, you can contribute another $6,500 on top of that, being over 50 years old. If you don't have access to a retirement plan through your employer, you can consider an IRA account, right? An individual retirement account. For this year, you can put in $6,000 into an IRA, and if you're over 50 years old, you can contribute an additional $1,000. And that IRA could be set up through a financial advisor. It could be self-directed through a a brokerage account like a Vanguard or a Fidelity. So those are some of the tools that you would use for your retirement savings. If you're self-employed, also not on this list, you may consider a SEP IRA. There's also 401ks for individuals and sole proprietors. So it really depends on how much you want to put away into your retirement, or how much you can, and then you kind of back into the retirement vehicle that you use. So when we put money into a retirement account, there's two ways that the money goes in, right? We could put in tax deferred money, which means that the money comes out of your paycheck before any taxes are taken out of it, and then you wouldn't actually realize taxes on it until you take distributions from it in retirement, right? So we do this when there's an expectation that our tax rate or a tax situation is going to be the same or better in retirement, right? If we're in a position where maybe we're a low earner, or maybe we're self-employed and we're having a year where it's we earn less than we normally do. We saw that last year because of COVID. You may want to consider a Roth IRA or a Roth contribution to a 401k or 403b plan. So a Roth means the money is taken out of for taxes. Your income taxes are taken out in the year that you make the contribution, but now that money grows tax free. So whenever you take that money out, you don't have to pay taxes. So ideally, it's good to have some combination of these two, some tax free growth and some tax deferred growth. But what we see on the screen is, there is a benefit to tax deferral, right? So if we put that money in pre-tax, we have more money to invest and more money, more growth opportunities in it. That for this example, they're assuming that your tax rate remains the same. Let's say it's 25%, and if you were to put in that same amount, call it $19,500, and contribute the $100 a month over 20 years, after taxes, you would be left with $92,000 in change, versus if you just use the taxable savings account. So there is a benefit to tax deferral, especially when we think that our tax situation is going to be the same or lower in retirement, right? Because we want to defer paying taxes now while our tax rate is higher and we're working, knowing that in retirement we're going to be showing less income and we could take it out at a lower tax rate. Okay, so now that we have an idea of the type of retirement vehicle that we're going to use, okay, what are we going to put in the retirement vehicle, right? And again, I'm speaking mostly about retirement, but there's other savings goals that we have too, right? There's 529 plans for our college savings. We might have a brokerage account where it's just general savings or saving for a house or another financial goal that we have. So there are other different types of investment vehicles outside of retirement ones, and we want to select the appropriate one depending on the goal that we have, right? So once we've done that, we have to figure out what we're going to invest in and what our investment approach should be, right? So when we start thinking about an asset allocation, okay, we want to consider three factors. We want to consider when we're going to need the money. Okay, what's our time horizon going to be for the money? So if we're not planning on touching this money for 20 years, well, we're really not going to be as vulnerable to the ups and downs of the market, right? We know that we have long lengths of time for the market to recover. We could use those times when the market goes down as opportunities to enter in at lower points. And if our approach is, if our time horizon is long term, we could really invest for growth and stomach some of the volatility that could come with that, right? In addition to our time horizon, we also want to think about our personal risk tolerance, right? Some people, they might have a long time frame, but really just can't stomach the fluctuations of the market or wild swings in their account. And if you're that type of a person, then you really have to adjust your investment approach accordingly, because the only investment approach that's going to work is going to be the one that you're going to stick with. If you're just going to fill out a questionnaire based off of how you think you should invest, based off of your situation, what other people are doing, then it's you're vulnerable to abandoning that approach at inopportune times, right? So if you invest a little bit more aggressively than maybe you're comfortable with, then when we do see those pullbacks in the market, you might adjust your approach and panic. So factoring in your own risk tolerance is going to be important as well. Let me I just lost my little light here. There we go. Let's see if I can actually keep this on. Should have all these Zoom and virtual difficulties taken care of, but they still always come up, right? Okay, going back to your investment approach, we also want to look at what your goals are, right? So whether it's saving for retirement, whether it's saving for a home, or potentially a rental property, or just for your retirement, we have to quantify how much that goal is going to cost, how much time we have to get there, and what type of investment returns would we need, to basically reach those goals, right? So we want to align our investment strategies with those different goals, right? So we might have different accounts that have completely different asset allocations because the purpose for those savings is different, right? So that's how we start thinking about our investment strategy, right? When we think about what we have at our disposal to come up with an asset allocation, right? We're talking about some of the higher risk things like stocks, right? Starting with growth stocks, right? Small cap stocks, and then maybe a little bit less volatile would be dividend paying stocks, value stocks, more established companies. And then we go down the list to bonds, right? So there's all different types of bonds we can invest in, whether it be government bonds, municipal bonds offered by states. It could be investment grade corporate bonds, which are better credit quality. Could be high yield bonds that are lower credit quality, but might offer us a better potential return. And then going down the list to money market instruments, CDs, just holding straight cash. So, we focus a lot on the funds that we pick, right, and the managers that we use and things like that, especially in my industry. But really, your asset allocation is going to be determined about 90% of the variability in your portfolio. So making sure that you have the proper asset allocation is going to be a great start to setting up your investment approach. So everything that we do has a trade-off between the potential returns that we could see versus the risks that they carry, right? So historically, we know that if we look over the past 100 years, small cap stocks, and even I would put real estate and REITs into this category, have offered us the largest annualized return, right? But they've also been the most volatile, okay? Followed by large cap stocks, giving us a 10% return, government bonds, a little bit over 5%, going down to treasury bills, which are much shorter term. They mature within 2 years, give us a smaller return than that, and then cash is below that. But so all of these things have historically outpaced inflation over the long term. Okay, over the short term, maybe not, right? This year we're seeing high inflation and we're seeing poor bond returns. But over the long term, all of these asset classes have outpaced inflation. So the question is what combination of each one of these should we have in our portfolio, and how much risk do we want to take on in our portfolio, and that'll help us determine the right combination of these assets.
Well, just a quick question. We had the
Yep.
session yesterday and we were focusing on recent graduates, and we talked about building habits and investing, and so much of it is psychological, and that they would see things like downturns over the years and inflation and different things in different cycles, but not to sweat it because there's plenty of time. And to know going in, you're going to have some volatility, but over the long term, you're going to be okay. But in this time horizon, it's probably a little bit more common to say we've shifted from there's plenty of time to not as much, but do you feel the same point still remains that we shouldn't get too concerned about what we're seeing because it's not like we're imminently there, about to cross the finish line.
Yeah. So I mean, let's start with retirement, right? So retirement, if you're planning on working for an additional 20 years, that's still a pretty long time frame, right? Even 15 years. But yeah, once you start getting, especially within 10 years, um, that maybe that passive approach to just a target date fund or maybe some funds at Vanguard, maybe that approach doesn't work anymore because as you get closer to your retirement, especially within those last 10 years, you do want to focus more on risk mitigation and potentially making changes to your portfolio. Another thing that we go through at this age is maybe we have some kids that are getting close to college, right? I still have a little ways to go with mine being 10 and 7, but already I'm starting to think about when how aggressively should those 529s be invested as they get closer to 18 years old. So no, it is a real concern, and I don't think it should just be don't look at this at all, just keep dollar cost averaging in anymore. That got us to where we are, and it's great. And for the first 20, maybe even 30 years of your working life, I think that that's the right approach. But now, as we do kind of go into this home stretch, um, you know, we have to look at this more often and potentially make changes as we get closer to retirement and as we dial in to what that retirement picture is going to look like for us. So just going back to inflation, just this is another way to illustrate it, right? So if we had, basically $1,000 today, and at 3%, 20 years from now, that $1,000 in purchasing power is going to be worth less than half, right? So again, you know, we have to keep cash on hand, right? And we're going to go over that a little bit on how much you should keep. But we also have to be mindful of is while investing in the market, there's certainly risks involved in that, but there's also risks involved in non-investing too, right? So we need to find a balance there. So just going back to how do we balance those risks, right? And again, I want you to look at this in time frames, and I do this with people that are at retirement, right? I mean, I had several clients that retired through COVID. I mean, think about how stressful that was. 30+% sell off in the market in the quickest amount of time in history, basically. And the way that we looked at it was in time frames, right? So if I were to tell you that we were going to put all of your money out here on the table, and now I was going to give you 3 buckets, right? And those buckets were basically represented different time frames, right? And maybe for a retiree, it might be that first bucket might be what do they need for the next 2 to 3 years, right? We might keep that in cash, online savings, CDs, right? Something very liquid and available to them. That next bucket might be that next wave out of 3 to 7 years, 3 to 8 years. And that bucket of money might be mostly in bonds, right? A lot of high quality investment grade bonds, highly rated municipal bonds, treasuries, T-bills, and that would be basically our next line of defense, right? And then when we've established those first 2 buckets, what's the money that we know that we're, even if we're in retirement and we're living off of our money, what's the money we know we're not going to need for a while? Maybe we have 7-8 years of our expenses completely lined up now. That's where we're going to start looking at risk assets. And while we might not be as close to retirement, the approach is very similar, right? So we might look at a Roth IRA that we're getting tax-free growth in as something that we're probably going to touch last. And maybe that's going to be, it could be based off a time frame, it could be our most aggressive account. Many of us are still comfortable in a retirement account, still keeping a more aggressive approach, whatever that means to you, whether it's 70% equities, 80% equities, whatever it is. But if we're going to take some risk and invest in growth assets, in our situation, our retirement accounts are probably the best place to do that, right? Now, if we're closer to retirement than that, or maybe we're talking about our kids' 529 plans, or just money that we're already maximizing our retirement savings. So we have additional savings that we have invested, and we don't know what the time frame is, but we don't need it anytime soon, right? Maybe we throw that into an intermediate time frame, and we're going to be less aggressive with that money, right? We're not going to be as heavily into stocks, and we're going to rely a bit more on bonds, and whether it's 50-50 or whatever it makes sense for that to be, but it's not going to be as aggressive as our retirement accounts. And lastly, what do we have a tighter time frame for? Maybe our kids are just that much closer to going to college. Maybe they're 16, 17 years old. Maybe we are close to a financial goal, like buying a home or a second property or a business, and we expect to do that within the next few years. Well, you don't want to open yourself up to too much volatility in the market and fluctuations in this account or with this money. So we might take a much more conservative approach to that money, and invest it accordingly with bonds. So again, when we were younger, it might have just been our retirement savings, and we had a long way to go, and we just stayed aggressive. But now things are starting to get more complicated, and it doesn't have to be a one-size-fits-all approach, right? We have different goals, and we should have different asset allocations, to match each one of those. Going back to my example of as you're getting closer to retirement, it's not just set it and forget it anymore. You have to review it regularly, right? As we're getting older here, and maybe we have families, maybe our kids are getting older, but maybe our parents are definitely getting older. It just seems like our situation is changing more frequently, and because of that, you really want to look at what's going on in your accounts and make sure it's still aligned to where you're looking to go, to what your goals are and what's happening in your life, and you can make those modifications as your circumstances change, right? And obviously, I'm always going to advocate for working with a professional, right? I always say that we don't get hired to make the plan, right? We get hired to change the plan, right? To look 5 years out and at the things that maybe you're not considering as you have your head down and work and your family and things like that. We get tunnel vision and we're looking at what's in front of us. But what a financial planner may do for you is kind of look a little further than that and present you with the things that you should be considering given your situation. So especially through COVID, we're seeing a lot more movement, right, in our careers. I mean, I'm seeing a ton of that with clients, just people going back to the office, switching jobs, switching careers altogether. We were cooped up for a while, and it gave us a lot of time to think. So if you are going to leave your job and you do have a retirement plan there, you should know what your options are, right? In many cases, the sponsor of that retirement plan will allow you to keep your investments in that plan, okay? If you start a new job and they offer a new plan, well, it may make sense for you to move the assets to the new plan for the simple sake of consolidation. You also have the option of moving the assets from an old retirement plan to a rollover IRA. And the reason that people would consider moving their assets out of a employer-sponsored retirement plan into an IRA is simply more flexibility. You could pick the investment firm that it's with. whether Vanguard, Fidelity, Schwab, wherever it is, you could pick the investments. You'll have a much more choices as to the investments that you could use in the account. And it also gives you the opportunity to work with an advisor if you want to, right? So most advisors aren't able to really advise directly and manage assets in a retirement plan, but they can in an IRA. So the last option would be taking a lump sum distribution, which I don't think is really an option for many people here, right? If you were to take money out of a retirement plan before you're 59 and a half, you would pay a 10% penalty in addition to income taxes. So until we're ready for the money in retirement, your options are really to leave it, move it to a new plan, or roll it over to an IRA. So we spoke a little bit about this before, but we have more financial goals now than we did when we started, which was just retirement, right? So I mean, part of the reason I left Wall Street and got into financial planning was I had to juggle the things that we see on the screen here, right? I had a newborn and a 2-year-old at home. I was obviously saving for my retirement, and my dad got sick with Lewy Body Dementia. Once that happened, I was put in charge of managing my own family's finances, and really saw the benefits of financial planning and saw how overwhelming it could be. So, if your parents are healthy, that's great, but make sure you have a conversation with them and know, do they have long-term care insurance? Is their financial situation strong enough where they wouldn't rely on you in the future? And if you are in the situation where you're supporting them, I understand the challenges involved in that, and it's just another thing that we have to balance. And as we, if this is for people in their 40s or mid 40s or whatever, we're going to start seeing it more and more, maybe in our own family and with some of our friends. If we're ever put in a situation of being a caregiver for our parents, we have to understand that by being put in that situation, it could jeopardize our own retirement. And I'm not saying that some people have no choice and that's just what they have to do. But remember, for those years that you're not working, you're not contributing to your payroll taxes, and you're not contributing to your future Social Security benefit. When you do go back, and maybe more difficult to re-enter the workforce, and you might incur more out-of-pocket expenses if you're helping your family financially. So again, it's important to have these conversations with our family early to make sure that there's a plan in place if you ever did have to take care of your parents or another family member. A bit non-financial, but very, very important to financial planning is do we have the proper estate planning documents in place, right? So that would be a will, right? So what are our directives of what would happen to our property? What would happen if we have children that are minors? Who would be the guardians of those, right? Is a trust necessary? Trusts are used for all types of purposes. One of the most common is a revocable trust, which you maintain control over, but it avoids probate if something were to happen to you, because we know that the probate process, the probate court, could take a while to basically settle an estate. Do we have insurance policies, right? So if something were to happen to us, is our family protected? Do we have life insurance, disability? On those policies, do we have the correct beneficiaries on them, right? Whether it be our spouse, our children, a trust that we set up. Make sure that your estate planning documents are talking to your insurance policies and everything would flow properly. Same thing goes with all your retirement accounts. All retirement accounts should have a beneficiary on them. Make sure that those are up to date. Maybe we got divorced, remarried, changed our beneficiaries at some point, but didn't do it on all of our accounts. If you have non-retirement accounts, you could still assign a beneficiary. For an investment account, it's called a transfer on death account. It's something that you may want to consider as well. So make sure you have your estate planning documents in place, and also make sure that the beneficiaries are correct on your insurance policies and investment accounts. So when we talk about estate taxes, I'll talk very briefly about this, but the limit on our estates was basically doubled in 2017, right? So a married couple went where it's from $11.8 million that they were able to have in net worth without being subject to any estate tax, and it doubled to 22.36 million. So needless to say, most of my clients weren't worried about estate taxes because most of them fall under $22 million in net worth. What we have to watch now going forward is, one, it's going to revert back to the old number in 2026, but also with the proposed tax changes that the Biden administration has on the table right now, ever changing. But one of the things on there is basically reverting the estate tax limit back down to the roughly 6 million individual and 12 million for a married couple. So something that we're watching. So to recap here, you want to put your retirement action plan to work, right? So we talked about establishing a timeline savings goal, making regular contributions to your retirement accounts, making sure we're investing our savings to outpace inflation. If you're older than 50, making sure you're taking advantage of a catch-up contribution if you can. Review your asset allocation regularly as your situation changes and make adjustments, and work with a professional to help you along the way here. Okay, so I'm going to go through the next few slides, somewhat quickly because I'm looking at the time here. But I just want to give you a few just pointers as we have 2 months to go left in the year, and what you should be looking at going into year end, and how to set yourself up the best you can for 2022, right? So excuse me if I go a little bit quickly, but this was a crazy year, right? The economy opened. While some things went back to normal, other things, didn't yet. So, if we had a financial plan in place, were we able to stick with it? Were we able to meet our savings goals? Stick with our investment plan? If there were changes along the way, did we make the appropriate changes? And most importantly, how does 2022 look? And do we need to make changes to our investment approach going forward? Okay. So again, it all starts with savings, right? So in order to have savings, we have to have a good idea of our spending. I'm not a huge advocate for budgets, but I do believe that tracking spending is a valuable tool to see what our spending habits are, to see if we should make some lifestyle adjustments to basically, manage our expenses so we're able to save more. Okay, and there's different online tools you could use. You could use end of year credit card statements to kind of get a sense of where your spending is going, to see if you need to make any modifications for the next year. So as important as investing is, we have to keep cash on hand, right? We call it an emergency fund, a reserve fund, whatever you want to call it. Rule of thumb says we should keep 3 to 6 months of expenses in cash, right? If you're in retirement, living off of your money, or maybe you're self-employed and have more variable income, you might want to keep more money in cash, right? It really depends on your situation, but we need to figure out how much cash is appropriate for us to hold, and make sure that we have that in cash, and we're investing the difference. One of the biggest challenges I see in this age group is trying to figure out how much cash to have on hand versus how much can we invest. Okay, so again, everyone's situation is different. You have 2 months left to basically max out your retirement plans, right? So we went over what those maximums are. For a simple IRA, it's a bit lower at $13,500, but if you feel like you've underfunded your retirement savings for 2021, reach out to your HR department and try and get that contribution in before year end. Okay. Does a Roth conversion make sense? Generally speaking, if you're in a year where your income really took a dip, it might make sense to convert some of your pre-tax retirement savings to a Roth IRA. You're going to realize the taxes on whatever you convert in 2021, but if you're in a low tax bracket and you expect it to be higher in the future, a Roth conversion may make sense for you. Check your non-retirement investment accounts. Do you have any losses that make sense to take before year end, right? By taking capital losses on an investment, we could actually take offsetting gains in it, right? We call this tax harvesting, where we're allowed to take $3,000 in losses against our income. But if it's anything more than that, it will get rolled over to the following year. So if we have some gains that we could take in our account, we could offset some of the losses and harvest those gains. Again, in a year where the market's really just been straight up, we're not seeing much of that. But last year, where there was more volatility, there were certainly opportunities. If you're feeling charitable, above the line charitable donations for 2021, you could deduct up to $300 single, $600 married. You have till December 31st. But if you donate on a regular basis, or you're donating more than that, you really want to have a good strategy for donating, and making sure that you're getting some type of tax benefit for it. So for some of us, if we're not itemizing, it might mean bunching charitable giving into one given year to get us over that standard deduction, so we see a meaningful deduction from it. Otherwise, if our charitable giving still keeps us under the standard deduction, the most we're getting is a $600 deduction. So having a plan in place, donor advised funds are a great way to save over time. Talking to Binghamton is also a great thing to support our college, and for all they've done for us. That's a great place to start too. If you're contributing to a 529 plan, a lot of states offer a state tax deduction up to 10. New York and New Jersey. New Jersey, there's no deduction. In Connecticut and New York, up to $10,000 in 529 contributions, you can deduct from your state income tax. So get that in before the end of the year. Really quickly, if you're in a high deductible health insurance plan, you may be eligible for an HSA account, health savings account, a way for you to put away tax deferred money to pay for your medical expenses down the road. Unlike a flexible spending account, you don't have to pay it down by the end of the year. So you could fund this account, even invest it, have the funds grow tax-free, and use that money later on. So I apologize for kind of going through those last few slides quickly. I do have my contact information if you have any questions. I really appreciate Binghamton giving me the opportunity to talk to all of you here. Binghamton just just holds such an important place in my heart, and I'm always happy to kind of contribute when these things come up. So if you have any questions, please fire them away right now while we still have some time. But otherwise, don't be a stranger. Feel free to reach out anytime, and I'm happy to answer any questions on anything that I've gone over.
Paul, thank you very much for an extremely informative presentation. And boy, it was a lot to squeeze in just 1 hour, and then we got so much into it. And it's like, wow, just 10 minutes left, and quite a lot, especially at the end. One question I have, and you had talked earlier about the importance of working with a professional and the benefits of working with a professional. And there's probably some people that have never worked with anyone, been flying on their own all this time, or maybe they have worked with somebody and the relationship just isn't quite maybe what they want. So what should they be looking for in choosing somebody? It's not as simple, I'm sure, as let's go ahead and search for somebody in my area, and whatever search engine optimizes, we go with one of the first 5, and something like that.
Yeah, so I mean, I'm a huge advocate for financial planning and being a fiduciary. So I think you should start by looking for a certified financial planner, right? With that designation, we have this oath that we have to be a fiduciary to our clients, and we're monitored for that. And if you go to the cfpboard.net or cfp.net, there's actually a find a planner feature there where it has a directory, and you could find certified financial planners in your area, and it'll show you what their expertise is. I run an independent practice. I think there's a lot of benefits to working with an independent firm, a firm that doesn't have their own investment products, right? So they're not beholden to any type of products that they need to use, or sales quotas, or anything like that. So I think that finding somebody who's independent, who's a fiduciary, and hopefully has their CFP designation is a great place to start.
And we do have one question that just came in by email. Can you still contribute to a 529 and pay existing student loans once your child has graduated?
So Can you contribute to a 529, or could you use it to pay the student loans? That
It's not altogether clear, so I'll read it again, and this is literally all I have. It just says, can you still contribute to a 529 and pay existing student loans once the child is graduated?
I don't believe that you could use the 529 funds to pay the student loans. I don't believe that that's and I'd have to double check that, but I don't believe that that's an eligible education expense. But I also don't believe that there's anything preventing you from contributing to a 529 while paying off student loans. So I hope that helps. I don't think you could use the 529 funds to pay down student loans, though.
Maybe I could just forward the email to you, and if you don't
Sure.
mind, I feel like there's more to dive into in that situation.
Yeah, I'm happy to do it.
Well, that takes us right to 1 o'clock, and we don't have any more viewer questions, so this would be probably a neat place to wrap up for today. Paul, again, thank you very much for your time. I know you're very, very passionate about your Binghamton experience, and you really love the university and want to be involved with other alumni, and then also share your expertise. And I hope people got a lot from the program. I hope they'll use the information in some way to help them at whatever stage they're in now. But thank you so much for your time that you spent with us today. We really appreciate it.
Yeah, thank you, Steve. This was fun. I appreciate everyone's time out there.
And we'll be back tomorrow at noon Eastern with the third of our 3 retirement planning webinars. This one is called Life's Retirement Derailers. This is meant for people in the later stage of their career getting ready for retirement. We broadcast live on Facebook, facebook.com/Binghamton alum. So share that with anybody that you think may be interested. And thank you so much for joining us today. And from Binghamton University, we say goodbye and have a great rest of the day.